Hello and welcome to our weekly look ahead at the markets. And obviously it's been pretty volatile over the last few days. We saw quite a rip in the bond market, the US 10-year Treasury hitting fresh 16-year highs. You've probably heard that a million times over the recent days and weeks. But new 16-year highs last week above that 5% level. We saw a big retrace though on Monday into Tuesday as it dipped to 4.8% and then rebounded. That was after Bill Ackman said that he'd closed his short Treasury bet. So we're looking at investors deciding whether or not the Fed is going to maintain this higher for longer stance in the face potentially of a deteriorating Q4 economic situation and into 2024. Potentially some further weakness, signs of cracks among consumers. So this week's data is going to be key, and data and central bank decisions, because we have the Fed coming up on Wednesday. The decision is expected to leave rates on hold. Fed funds futures showing that the market is absolutely dead set on that. The question really though is on what sort of outlet they're offering, what sort of messaging they're offering around that higher for longer mantra, what sort of risks they see. Do they actually look at inflation being facing some upside risks because of the oil price and because of geopolitical tensions? Remember, war is inflationary, and that escalation of potential in the Middle East will be feeding into expectations around inflation, particularly in central bank meeting rooms. So they'll be looking at these oil prices and thinking perhaps there is actually some inflationary pressures coming back in. So after lots of disinflation in recent months, we'll potentially be seeing some new inflation coming through if the oil prices remain higher, and if there's more escalation in the Middle East, what that could mean going forward. Elsewhere we have Bank of England also expected to leave rates on hold. It's facing a pretty nasty cocktail of economic risks. Inflation remains too high. It remains stubbornly high at 6.7% at the last outing. So lots of risks for the Bank of England, but it looks like there's limited upside from them pushing for an extra rate hike. It looks like, very much like the Fed and the ECB, they're on hold. It's a case of saying, look, we're pausing, we're going to leave rates to catch up, we're going to leave the effects of monetary policy tightening to catch up over the coming months. And as inflation comes down, disinflation persists, and inflation expectations also maybe start to decline, then that policy will become ever more restrictive, and that's kind of what they're hoping for. So we think Bank of England holds. We also think Bank of Japan is unlikely to do anything this week when it meets, but it could be offering some signals, or probably will be offering some signals about any tweaks to yield curve control and ending negative rates. Remember, its own gauge of inflation, the year-over-year median 3-month average, that is at 2% now. So that's that 2% target that it's been saying it needs to hit, and hit sustainably before it will end negative rates. So looking at the Bank of Japan, it could be offering a hawkish surprise, so keep your eyes on that one. We did see 150 breached again last week on the dollar yen cross, and it looks potentially like there was intervention again. So the Bank of Japan is wary, the Ministry of Finance is very wary about that 150 level. Perhaps arguably the best thing they could do is just start to normalise policy. The Japanese economy has been doing pretty well recently, and you think that they could be doing that. They should have been doing that now, and in fact they might be missing the window, because by the time they get round to it, the rest of the world might be into cutting mode depending on how bad things get over the coming months. We also have non-farm payrolls from the US, and arguably more important than even the Fed decision, because higher for longer depends squarely on the labour market holding up. So as long as the disinflationary trend persists, they're going to keep rates high. They're not going to be thinking about cutting until the labour market starts to crack. As long as the labour market remains strong, there's no rationale for cutting. So that's the key one. Remember, 33 months in a row. It surprised to the upside, 336,000 last time out, and there was some softness in the wage data. So looking to see what these non-farm payrolls are offering. We have had weekly unemployment claims running around that 200k mark for some time now. And ahead of that, non-farm payrolls, of course, you get the ADP, you get the JOLTS numbers. Remember, it was the JOLTS numbers that signalled the hot labour market a month ago. So looking to see if JOLTS again signal some heat in the labour market. And then finally, earnings season continues both sides of the Atlantic, but the big highlight will be Apple, just seeing just how poorly the new iPhone has performed, or how well it's performed, but certainly signals so far have not been too great on that new iPhone. So we'll be looking to see whether or not Apple can hold up the tech sector and the entire market. Everything's going to be hinging on that report. After Alphabet's weakness in cloud revenues saw its shares decline 10% in a single day last week. Meta, despite topping revenue expectations and earnings expectations, its shares fell after earnings because of weakness in the outlook, had a big knock-on effect to other companies in the sector, notably Amazon as well. So tech sector has been holding up the entire global equity market this year, and so a lot will be riding on those Apple earnings figures, which are coming out this week. So that's it for the moment. Keep your eyes peeled for any new news, and we'll let you know if anything's happening. Thanks for watching.